Good afternoon, everyone. First of all, I would like to thank the organizer, Sushanta, for inviting me here. This is indeed a great pleasure to be here. And I'm really grateful for the opportunity to discuss this paper. I think this is the right audience for this paper. This is something which we have been doing. It's a joint work with the Udici Bose and Sarafim Sukas. We are looking at a regime shift in from Foreign Exchange Regulation Act, which was in place since 1973, and that was replaced in 2000 with the Foreign Exchange Management Act. So due to this regulation shift, we are trying to understand to what extent exporting firms have benefited from this regulation shift. So we try to look at two categories of firms. Firms, those who are exporting, and whether how they have benefited after the change in policy initiative since 2000, and the firms, those who are not using this any kind of foreign financing. So it's basically there are two categories of firms. One with the those who are using foreign financing, those who are not using foreign financing. Why it is important? We have seen these capital controls in many developing countries, and this has been since 91, mid 80s and 90s, many countries have liberalized, but there are still capital controls in countries like China and India, which are growing rapidly, but they still maintain a closed capital account. So if we look at the degree of financial openness using this Gini-Ito index, we would see here that a lot of these emerging markets do maintain a closed capital account, particularly China and India. This is the straight flat line here, the green and black line, and India and China, they tend to have closed capital account. So there are restrictions on capital account transactions. So clearly that will make that will create financial constraints for firms, those who would like to get involved in international transactions, either exporting or investing and so on. So here we are focusing on only firms, those who are exporting. And if you ease this financial constraint, to what extent it benefits this category of firms as opposed to those who don't use this form of financing. And we have seen that another important thing is, since the global financial crisis, you have increasing use of capital controls, and that could reduce the degree of financial openness, and it will create financial constraints for these exporting firms or outward looking oriented firms. So what we see from the literature is that this is clearly anybody who is trying to become an exporter, you have a huge entry cost, and therefore, to meet that entry cost, to overcome this entry cost, you need financing. So the ones who are financially healthy have better access to external finance relative to the ones who are not financially healthy. Therefore, for developing countries in particular, the firms or access to trade finance remains costly and limited, and therefore the trade expansion could be constraining. Because our focus is more on Indian firms, so therefore this policy initiative we want to see whether it had any impact on their exporting intensity. So a lot of this I am not going to go through, but these detailed the regulations, they are discussed in this paper, Patnaik et al. 2015, very clearly. I don't want to go into the details, but I just want to make the point that there has been this policy shift and what extent it has changed the behavior of exporting firms. Another reason why it is important, because interest rates used to be, for firms operating from India, they used to experience interest rates which are lower, relatively lower in the international market, international debt market, relative to borrowing locally. So therefore, it's cheaper for them to borrow overseas rather than borrowing locally, and also clearly for any international transaction you need access to foreign currency. So, so our idea here is that since this FEMA was introduced, to what extent firms have benefited, and this limit since 2000, it was $50 million firms could borrow, okay, around that time, and this limit has been relaxed over time. This limit has been relaxed over time, and right now it's around $750 million they could maximum borrow with RBI approval, but no, sorry, without RBI approval, but with RBI approval it could be bigger. But clearly there are limits in place. So let's look at the since 2000 you tend to see an increasing use of ECB, and you can see there are more firms using ECB today than what they were doing. Of course, there has been a decline since 2010, but you have bigger number of firms using ECB, and among them, among those firms, most of them are exporting firms, as you can see here. There is a big sharp increase in that since 2000. So now, because we are trying to have a causal identification, I wanted to show this that graph. And there are three key questions that we are asking. First, we are looking at this particular policy initiative, whether it had any impact on firms' export intensity. Second, firms do get the grants and subsidies. All firms get, okay, for different regions. But the exporting firms, those who receive these grants, do they derive any positive benefit from these grants? So grants per se may be effective or may not be effective, but the firms, those who use ECB, they tend to benefit positively from these grants. So we're going to look at that. Finally, there are firms, as discussed earlier, who are operating in more volatile industries, or they are themselves experiencing higher volatility at firm level. So we uncover the both. So the firms which are more volatile, one could interpret that as they are more constrained, and similarly, the firms those are operating in more volatile industries, they could be more constrained financially, and therefore, whether these firms benefit differently from use of ECB. So that's how we are looking at. So the main outcome variable is exporting intensity. It's defined as exports, the share of exports in total sales. And so the treatment clearly, the temporal variation that we are trying to uncover here is this policy shift. Okay. Now, so you have this allows us to separate the firms into two categories: ones with use of ECB, and others those who don't use, but they're still exporting firms, but they don't use. So it is possible that you would argue that their financing or access to external financing could be conditional on their exporting status. Okay, so there is some degree of endogeneity. So what we need to do is that we need to create a matched sample. Create a matched sample, and if you just separate the firms by matching their characteristics across different covariates that we have considered, across different characteristics, we find that the firms with use of ECB tend to have a better exporting performance relative to the ones those who don't use ECB. Okay, this coefficient is statistically significant. So Then we try to match, and how good is this matching? How good is the match sample? All these characteristics are matched. Both for the treated and control, you can see they are similar. Therefore, there is no significant difference between these two categories of firm across these covariates. Now, this is an important assumption for to undertake this analysis. So, if we did not have this intervention in 2000, they would have tracked closely to each other, these two categories of firms. So, therefore, this policy shift or this policy intervention could be driving why these treated firms are doing better relative to the ones who don't use ECB. Okay? So, that's how we are trying to separate the firms into two categories. I'm not going to go through the details. This is very familiar to this audience here, but this is the model that we use. So, our main variable here is this one, alpha 3. That's what is capturing the policy liberalization effect. Okay? So, that's the treatment. This is the temporal variation. The interaction here is capturing whether the firms, those who are using ECB, are able to benefit or have benefited differently relative to the ones those who don't use. So, I'm going to, then the second one is looking at the ones, these firms, they are also receiving grants. So, that they are using ECB at the same time, they are receiving grants for different reasons. Could be interest subsidy, could be, buying, importing inputs, and so on, and so, or importing technology. So, do they, because they are using ECB, are they benefiting differently? Let me just, and then similarly, we look at the constraint firms at firm level as well as in industry level. Okay? So, do they, so has it helped these firms to benefit from this policy change? So, let me skip in the interest of time. So, what we find here is clearly the interaction effect here. So, the firms, those who use ECB, that's what we call treated, since 2000, they have derived, as you saw before, they have derived a significantly positive effect from this ability to use external financing. So, now similarly, because now if we just look at grants for all firms, anybody could be getting grants or subsidies. Even when the currency is appreciating, the government could actually step in and subsidize those firms in order to make it competitive for those firms. So, therefore, you could have, so if you consider the average effect for all firms, it is negative. Okay? So, that means grants per se is not effective. But if you look at those firms which are using ECB, probably they tend to be better performing firms. They derive a positive effect from grants, receiving grants. So, grants are more effective for those firms, not for everybody else. Okay? Similarly, if we try to deal with this financial vulnerability, as I mentioned, we separate firms on the basis of the ones who are experiencing higher volatility at firm level, meaning they are more constrained, and the ones who are facing at higher volatility at industry level, or if they are operating in an industry which is experiencing higher volatility, whether those firms are able to benefit from the use of this external financing from overseas. So, now what we find here very clearly, the firms those who are operating in constrained or financially constrained or experiencing more volatility, whether at firm level or at industry level, they are able to, they have benefited during this treatment period or since 2000. So, we have a range of, because I have no time, so we have a range of robustness checks we have undertaken in order to validate, why it should be 2000. It could be also a different point in the past. So if we take a different point, not 2000, let's take a 97, but you don't find any significant effect. Okay, so clearly you tend to see since 2000 onwards there has been a positive effect of this ECB use on exporting performance. So I'll just skip everything. I'll probably pick up during the discussion stage. And just to 30 seconds, I'll just summarize. So we undertook this DID analysis to show that firms, those who use foreign credit or external financing, because we know in general firms are constrained, those who use have the benefited during this FEMA regime, okay, relative to, we know they had no access before 2000, or only very big ones would had access. And whether this relationship is sensitive for firms, those who receive grants, and we also find that the constrained firms have benefited with this possibility of borrowing from overseas. And this, just to conclude, so what we find here is that easing these controls could actually help making firms more outward looking, or increasing the outward orientation of firms going forward. And this is something which could be taken up in future. Yeah, thank you.
Okay, so very quickly I'll summarize what the paper is doing, and then I have 4 major comments and some minor comments. So the question that the paper is looking at is what is the impact of FEMA, the Foreign Exchange Management Act, which was introduced in 2000, and liberalization of external commercial borrowings on Indian firms' share of exports. The research design that the authors use is, they use a combination of diff and diff and propensity score method. They compare the export share of firms before and after FEMA across treated and matched control firms. The treatment is the introduction of FEMA in 2000. Treated firms are the exporting firms who had access to ECB during 1988 to 2014. That's the full sample. Control firms are the exporting firms which have access only to domestic financing. Outcome variable is firms' export to sales ratio. FEMA is a dummy which takes the value 1 for the entire period of 2000 to 2014. They also look at some ancillary questions such as what is the role of government grants and subsidies on firms' export share, and what is the effect of output volatility on firms' export share of firms that can access external commercial borrowings. The results that they get, FEMA increases the export share of firms, those firms which have access to ECB, compared to those firms which have access only to domestic financing. The effect seems to be stronger for firms which receive government grants and subsidies. Financially vulnerable firms benefit more from access to ECB during the FEMA regime. So they conclude that capital account liberalization in early 2000s, essentially implying FEMA, has been effective in providing foreign financing to Indian firms, and this has increased the export intensity of these firms. The contribution, as claimed in the paper, is to study whether access to foreign financing increases firms' export intensity. So this is in a nutshell what the paper does. Now my first major comment. The introduction and conclusion of the paper says that they're analyzing the effectiveness of FEMA in enabling firms to access funds from abroad and in achieving greater globalization. In the research design, they're estimating the effect of FEMA on the export share of treated firms which had access to ECB during 1988 to 2014. This confused me a bit as to what exactly is the question. Are they looking at the effect of FEMA on firms' exports through the channel of ECB liberalization? Maybe that's the case because the treatment in their paper is FEMA. But the problem is firms had access to ECB even before FEMA. The second possibility is, are they looking at the effect of ECB access on firms' exports? Maybe because they are comparing between firms which had ECB access and firms which only had domestic financing. But if that's the case, then what's the relevance of FEMA, given that firms could already access foreign financing in the pre-FEMA period? And the result that they're getting is, after the introduction of FEMA, firms with access to external commercial borrowing increased their export shares compared to firms which did not have access to ECB. So what is the cause, or what is the event whose effect we are really trying to identify here, is not very clear from the description and the research design of the paper. Secondly, but this is a graph that they have in the paper, which is the share of firms' exports in sales over the entire sample period, and the vertical line is the year in which FEMA came about. If you see, before FEMA, the export to sales ratio went up from about 4% to 11%. Post-FEMA, it went up from 11% to slightly more than 14%. So what exactly is the magnitude of increase that we are talking about in firms' export share in the post-FEMA regime? And most importantly, is it really FEMA that is driving the result? And I'll come to the most important comment that I have. Now, whenever you're doing a DID method and you're isolating treatment and control firms, that's essentially based on the premise that one class of firms will be affected by the treatment and one class of firms will not be affected by the treatment. So accordingly, you have treated firms and you have control firms. In their paper, the treatment is FEMA. The problem is FEMA applied to all firms. Those with access to ECB, which is their treatment firms, those with access only to domestic financing, which is their control firms. So I don't really see where is a control group in the sample at all, because this is a law that applied to all Indian firms, all exporters, non-exporters, everybody. Now, if a firm decides to access ECB within the framework of FEMA, that's the firm's financing choice, and that could have been driven by a host of other factors. Or a firm may choose not to access foreign financing within the framework of FEMA. But FEMA by itself is applicable to all, so there is no clean treatment and control group here. Third, their treatment dummy takes the value 1 from a very long period of time, from 2000 to 2014. 14-15 years is too long a period of time to be able to cleanly isolate the effect of one treatment. Multiple other macroeconomic events could be happening around that same time, which would be increasing firms' export intensity. So I really don't think that any causal effect is coming out when you have such a long treatment period. Fourth, the paper I found is a little bit weak on institutional background, because FEMA was not just about external commercial borrowing. FEMA was also about FDI. FEMA was also about current account convertibility. So to just focus on one aspect of FEMA and say that that could have increased firms' export share, if at all that's what they're saying, is problematic. Finally, I have some minor comments. If ECB of firms is the treatment and the control, then it would have been nice to plot the median ECB of firms before and after FEMA. Because, as I said, firms did have access to foreign financing even before FEMA came about. And the main change from FERA to FEMA was basically that a criminalization condition was removed, that under FEMA, accessing foreign financing was no longer a criminal offense. It was basically charged by fine. Other than that, there really wasn't much of a change. In the sample, combining non-finance, non-banking finance, and banking companies is definitely not a good idea, because their capital structures are completely different. And if at all you should be looking at, it's only the non-financial firms. Third, the ancillary question of looking at role of grants and subsidies, I really don't think that's relevant to the main question if you're looking at the effect of FEMA and ECB. So it's not really, I thought it's not adding much value to the paper if you're looking at the grants and subsidy angle, and I'm done. Finally, paper uses output volatility as a measure of financial constraint. I think financial vulnerability or financial volatility is very different from financial constraint. And the authors should make a distinction between what exactly they are looking at. What can be done instead, I'll take 1 minute, is instead of looking at the effect of FEMA, which you really cannot, because as I said, FEMA applies to all firms, you don't have a treatment control, it's a 14-year period, you don't have a clean event. Post-introduction of FEMA, over a period of 15 years, RBI kept on issuing regulations from time to time to target specific industries such as real estate, IT, etc. And there you actually have a clean treatment control group, because the regulations would be affecting the firms in the real estate sector, but not the firms in the IT sector. And you could do a matching there, and then find out what is the effect of these regulations on firms' export share and what have you. I think that would be a much cleaner way of doing about it than what you have right now. Thank you.
Are there any other comments? Yes, please. Is that Anjali? Yes.
So I just want to pick up the thread on what Rajeshwari said about institutional design. I don't know about what the contours of FEMA in 2000, but I do have some familiarity with FEMA in the more recent years. And it appears to me that the primary users of FEMA are people who use it to import capital goods. And if, so there's data available on RBI website, there's time series of data available which shows which are the firms that used FEMA and what is the end use which they declared in their ECB form for which they were going to borrow this money. How much did they borrow, what end use, from whom, which maturity, all this data is available on time series. You may want to exploit some of that, because you know what's happening is this has gone into the zone of being generic, and FEMA is an extremely specific norm which applies to, say, there are 3 tracks in FEMA. One applies to manufacturing sector, one applies to real estate sector, one applies to the finance companies. And there's nice enough variation in the institutional design. There's clean data available on use of ECBs. I think, you know, you must exploit some of that, because this is going into the zone. It makes me worry that if the primary purpose was how are you defining export intensity, for example? Yeah, so it's a bit worrying, the result that you find, because I think that FEMA is an importer's law. The second part of it, the ECB part of FEMA, the ECB are not always attractive. Like Rajeshwari said, you have too long a period in which you find that ECBs lead to increased export intensity. The problem is there's a all-in cost ceiling in ECB, which is, I think most recently is 500 basis points. And the question is, there are periods of time in which ECBs are attractive, and there are periods of time when ECBs are not attractive for. Some of that variation is just getting lost because you just have this 2002 to sweeping sort of 12-year period in which your analysis is running. So I think that more nuanced analysis of using what the intervention itself will probably yield you more value.
Any other thoughts and comments? Yes, Josh?
I like the basic concept of the paper. I mean, I strongly believe that capital account liberalization must surely have helped exports grow. So, and you know, I'm not too bothered. I'm not as bothered as Rajeshwari. I mean, you can identify FEMA with capital account liberalization. I'm not so fussy on that. The problem I have is the endogeneity issue. That in order to access an ECB, you must be able to borrow at a certain spread or less. That means, by definition, that creditors believe you're a good company with good prospects. So then, ex post, if we find that this company has succeeded and grown, well, it shouldn't be too shocking. It may not be because of the liberalization per se. It may be because the creditors did a good job of picking the companies to lend to, right? So, and I'm not really sure how you're going to get around this problem.
Okay, anybody else? Yes, please.
But I have a different spin on this, which is the post-financial crisis. The post-financial crisis increase in the leverage, right? So what I'm hitting at is maybe if you can sort of move it to more recent dates, because we know that the leverage is really spiked up post-crisis like crazy for India and for the rest of the emerging markets. So maybe the countries who are going and doing these offshore debt issuances, especially non-financial corporations, they're really getting value out of it. What I'm suggesting is maybe moving the date somewhat to more recent, because there's a big conundrum now as to the exploding debt could actually hurt a lot of firms, and maybe there's a way to spin a story around it. We can talk more about it in the context of tomorrow's paper.
Vimal?
So one way to get around what Josh was trying to say is also that the RBI has an automatic and an approval route to get access to ECBs. So if there's any way you can tease out which firms did not get approval, which firms do not get approval, and then do your matching technology to say that they're very similar firms, but then the regulator did not allow some firms to get access to ECB, that would give you a better identification to estimate this effect.
Yeah, and I would just like to add one last comment. FEMA is sold in the economics literature as an important part of the Indian economic reforms. In fact, this was really not true. This is not a fair description of what happened. There was FERA and there was subordinated legislation under FERA, and violations were criminal. That was replaced by FEMA, and all the old regulations were just carried forward to FEMA. The only thing that changed was that instead of criminal, we got civil offenses. So there was no liberalization with FEMA. It was just a press release. The Reserve Bank of India controlled the drafting of FEMA, so they made sure there was no liberalization in there. Okay, so I really share Rajeshwari's sense that it's not an event you should use. You should go into the subordinated regulations. It's in the regs that you get the events. FEMA, FERA is no event. Okay, and by the way, in fact, I think BJP came to power in 2014. In 2015, criminal offenses were back in FEMA. So we're actually back to FERA, that certain offenses under FEMA today are back to criminal offenses. You've rolled back the reform of 1999. So, Sushant, 5 minutes for you to respond.
Yeah, no, thank you very much, Rajeshwari, for all the comments. As I said, this is something which we have been working for now a year now. But yeah, this paper is still work in progress, and clearly we'll be improving a lot of the comments made here. So let me, on the point that the main comment that you made about the treated group, clearly we took, during this time period, at any point, if a company used ECB, you might not be using every year, maybe at some point, 1 year, maybe they don't use the next year and so on. We call them as a treated group. And on your first main comment that it is possible that it is true that companies were using ECB even before 2000, right? So what we did, just to counter that point, we created an alternative treatment group where, I don't know why it's not in the paper, but probably I'll check that it was in my slides. Alternative treatment group where we considered firms which did not use ECB before 2000, okay, but they used ECB after 2000. So that way we can eliminate those firms, because these are the very big firms who used ECB before 2000. Okay, so that is, even when we do that, we still find the same significant variation between these two groups of firms. Okay, so that point, that can be, that concern can be addressed that by looking at this alternative treatment group results. Now, with regard to the financial constraints, of course, there are many ways in the literature people define constraints. So what we did, because we only had data, of course, we have data on sales, so you used it on a regression of sales growth on the lagged values, and with some time fixed, of course, control for time. Then take that residual and define the firms, those who are above the 50th percentile, the ones who are below, and that's how we define the financially vulnerable firms. But you know, there would be we will explore the other ways of defining and see whether the results change. But one point I must make here, that the firms, among these treated firms, the ones who are small size firms, they benefit significantly relative to the large firms. Large firms did not benefit after 2000 because they were already getting access to this ECB even before. So therefore, which is a good thing, because a lot of the small firms have become exporters, after 2000. And so therefore, you would think that the FEMA regulation has probably helped those firms. And I have a robustness on those results. But the industry point I take, industry idea, the variation across industries, which was mentioned. That is something which we are exploring. Still, we don't know if we can, but these are all mainly manufacturing firms, but it's important to categorize them and see, yeah. Yeah. Right, right, yeah.
Variation sitting there, which is useful to take into account.
The point made by Bimal, I will see if we can get this information with and without approval. That would be more interesting to have a clear causal identification.
RBI website
Is there?
That's right. Yes. So you just have to see whether the time series goes back to 2000 or not.
Yeah.
But I do know that the data is available and you can look at it.
Yeah, but yeah, thank you. The endogeneity, I mean, I know the matching is not a perfect way to deal with endogeneity, but you could actually, we did not use the unmatched sample. If we use unmatched sample and run panel regression, you will, in that unmatched sample, you have the significant bias, because if you look at the standardized residuals, there is a significant spread of those residuals. So they are not clustering around 0. So basically, in a matched sample, clearly all the covariates, there is no significant difference between the treatment group and the control group. So in that sense, I think we counter the endogeneity concern to some extent, not fully. It is difficult to do it, but partly we deal with the endogeneity issue by considering a matched sample as opposed to a unmatched sample.
Okay, Sushant, can we stop here? We are out of the time for this paper.
Yeah, yeah. No, thank you. I thank everyone for the comments. Will be looking into how to develop the paper further.
Thanks. Okay, so